Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Madison Mills. Let's get you the three things you need to know today. First up, U.S. stock futures falling alongside bonds and the dollar this morning as credit rating agency Moody's downgraded U.S. debt. Moody's announcing Friday evening it was stripping the American government of its top credit rating, citing concerns over the country's ballooning budget deficit and rising debt. Longer-dated Treasury yields rose to the psychological 5% level for the first time since 2023. And in Washington, President Trump's giant tax and spending package has advanced through a key House committee after facing hurdles last week. The bill still has to secure a full vote in the House before heading to the Senate, where it'll likely face fresh challenges. The package includes a major spending increase for immigration enforcement and the military. It would also extend Trump's 2017 tax cuts, which are scheduled to expire at the end of this year. Nvidia CEO Jensen Huang unveiling new products and a slew of announcements at the COMPUTEX conference in Taiwan. One of the most notable announcements, its new NVLink Fusion program, which will allow customers and partners to use non-Nvidia central processing units and graphics processing units together with Nvidia's products and its NVLink. The Sell America trade back in full force on Wall Street after Moody's cut the U.S. credit rating, citing concerns over the country's ballooning budget deficit and rising debt. So what does this mean for investors? Joining us now, Yahoo Finance's Josh Schaefer. Josh, we had a couple weeks of reprieve where we weren't talking Sell America constantly, but it seems like it's back this morning. How much do you think that this Sell America trade chapter of the story has legs?
Yeah, Maddie, I mean, if you just look at the market action this morning, you're certainly seeing that it has at least a little bit of legs, right? You have weaker dollar, you have Treasury yields up, you have futures tied to U.S. equities down. So, of course, that's sort of the core of what we have come to call that Sell America trade, right? But I think Wall Street strategists reacting to this Moody's downgrade of U.S. credit, essentially saying, I'd probably be buying the dip. So you had Tom Lee from Fundstrat saying that. Of course, people always like to say Tom is perhaps a little bit often bullish. But Mike Wilson over at Morgan Stanley, who has not necessarily been bullish on a consistent basis over the last couple of years, also coming out and saying he would buy the dip. So Lee over at Fundstrat essentially calling this a non-event and sort of pointing out that I don't think before last Friday, you or I weren't aware that we have a ballooning deficit here in the U.S., right? I think that is a rather an accepted fact that has been a part of the market, right? So if you were an equity investor and that was a concern on Thursday, I don't really know how much Friday's news from Moody's should really change your opinion. Wilson sort of pointing out that this actually comes at a good time just from the market narrative standpoint, right? So if you think about, we've had the S&P 500 up for 5 straight days. You have this 90-day tariff pause with China that's sort of spawned this stock market rally. You just had a positive earnings season. It's not like this is another negative headline on top of other negative headlines that keep coming through, which is sort of where we were a month ago. We're at a place now where maybe the market can sort of take a negative headline, swallow it, move on, and be in a better position, which I think, again, is a different spot than we were in at the start of April.
And historically speaking, you pointed out some data this morning indicating that downgrades like this, they don't typically lead to a huge market crash, right?
Yeah, so if you go back to 2011, you had the S&P downgrade of U.S. credit, and then if you go to 2023, you had a Fitch downgrade of U.S. credit. You did see markets fall in initial reaction to this. But if you look at a long-term chart from 2011 to now, of course, equities have done rather fine. If you look at a chart from 2023, August 2023 to now, stocks have held up pretty good. And I think importantly, both those time periods, while people were talking about recession, the U.S. economy didn't actually necessarily go into a recession in that time period, right? So it's sort of similar perhaps to right now, where we're talking about weaker economic data and sort of the overall growth concerns. And if you go back to 2023, that was sort of the recession that never came, right? So this isn't necessarily something that's telling you this an ominous thing is definitely coming. Again, not all of this not to say that the deficit doesn't matter, right? I understand the concerns there, and other guests will be able to explain that a little bit better for you. But just from an equity perspective, how strategists are talking about what this means for the stock market, essentially basically a non-event.
It's a zombie that appears at a date that we just don't know when it comes to the deficit.
Right.
One thing I am curious about is if we look super short term. Stuart Kaiser had a note out over the weekend on how this coming week we don't have a ton of eco data, we don't have a ton of huge movers when it comes to earnings. So is this going to continue to be the story throughout the week, this downgrade, putting a little bit of pressure on stocks, even if long term it's not a huge issue?
It feels like it, right? There's really just, if you look at the calendar this week, there's essentially no major economic data releases. There's basically nothing all week. Then you look from an earnings perspective, you have retailers where honestly the concern would probably be to the downside for some of the retailers, right? What are Target and Home Depot going to say about tariffs? Are they also going to talk about raising prices in the same way that Walmart did? And so when you think about just what's in focus this week, not a lot of potential upside catalysts, it doesn't seem. And think about the last month and a half, or I guess really probably since President Trump got in office in January, during a quiet week, Washington has sort of led the market, right? Investors are looking for something. So it's sort of been, Washington has been that key catalyst in the quiet weeks. I would probably expect that to be a leader for sure.
And maybe tariff negotiations, according to Hassett this morning. That's a key thing to watch this week as well. Josh, thank you as always. Really appreciate your insights. Well, Treasury Secretary Scott Bessent dismissed Moody's downgrade of U.S. credit as a lagging indicator in an interview with NBC on Sunday. Moody's stripping the U.S. of its last AAA credit rating Friday, pushing up yields and weighing on the dollar. So what does the downgrade mean for the broader U.S. economy? Joining me now, we've got Jason Furman. He's a professor of practice at Harvard University, former CEA chairman under former President Obama. Jason, it's always great to speak with you. Thank you for being here this morning. Just break this down for me. What does a downgrade like this mean for the U.S. economy, for consumers?
Look, there's no better understood security in the world than U.S. Treasuries. So no one needed this report to learn anything. But it's not backward looking. Congress is in the process right now of adding trillions of dollars to what is already a very high deficit. The debt is on track to continue to rise relative to the economy. And so the fiscal situation really is quite serious, even if we didn't learn something new about it on Friday.
So talk to me then, if the deficit situation is quite serious in your view, how serious is it? Can the U.S. pay back its debts?
Look, we can. We're a large economy. You can roll it over. You can pay it down over time. But for a way to that to work, we need our debt falling as a share of GDP rather than rising as a share of GDP. In order to get there, we're going to need to make a meaningful adjustment, an adjustment about the size of what we did in the early 1990s. Economically, that's absolutely doable. Politically is the much bigger challenge.
Yeah, and obviously this downgrade coming as the House Budget Committee last night has approved Trump's tax bill. I'm curious from your perspective, is this downgrade sort of a direct warning to Washington about those tax plans, especially given Moody's citing the fact that this tax plan could increase the deficit to 9% of GDP by 2035 when it's currently at around 6%?
Yeah, I mean, there's something very different about this downgrade than the last two. The first one, S&P, was all fears that government dysfunction. We'd just gone through the debt limit. There was this question of whether political paralysis could lead you to not pay the debt back. This time, it's unified Republican control. And what Moody's is concerned about is what those unified Republicans will do. Right now, they are set on increasing the debt, with the only debate being by how much.
So does the downgrade give momentum, I guess, to any side in Washington right now, maybe to the deficit hawks who do want more cuts to Medicaid, for example, or perhaps to those who are just more broadly concerned about the deficit?
Yeah, it probably helps the deficit hawks just a little bit. But by the way, those Medicaid cuts that are under consideration, those would only pay like 1/6 of the cost of the tax cuts. So that is not to reduce the deficit. That is to offset a little fraction of the costs of the tax cut. But, I don't think this will do that much to embolden the deficit hawks. They're just, full speed ahead right now on increasing the deficit and debt.
So, Jason, as someone who is obviously a Washington insider, it sounds like from what I'm hearing from you, we didn't have some Friday night secret emergency meeting of members of Congress about the downgrade from Moody's and how that could impact the tax plans. It sounds like what I'm hearing from you is there's not a huge read-through.
I think that's right. But I do think that higher long-term rates are here to stay. There may be more upward pressure than downward pressure. And at some point, that will bring people to the table to deal with our debt. I just don't think that point is right now.
Yeah, certainly. And I know you mentioned the fact that the bond market kind of doesn't lie. I wonder if you think that a 30-year yield at 5%, if it's not going to reign in Congress, is there any evidence that it reigns in the president, given that he recently has talked about the yips in the bond market and cited that as a reason to shift course on tariff policy?
I think he is really, really deeply believes in these tax cuts. That's the thing that is increasing the deficit here. But look, we're going to be in a place where mortgage rates may be higher at the end of the year than they were last year. And that will start to get people's attention. For now, a lot of people in Washington have kidded themselves into thinking that the combination of DOGE and tariffs will bring the deficit down. And, the numbers won't lie. We're going to see what the deficit is this year. We're going to see what it is next year. I think it'll be about $2 trillion a year. And at some point, it'll be clear that this approach didn't work. Ronald Reagan raised the deficit a lot in his first year and then reversed himself and came back to cutting it in his next 7 years in office. We should hope for something like that to happen here.
And Jason, one thing we haven't really talked about is the other side of this bill. It obviously increases spending, but some of my sources talk about how it also increases growth at a time when you have consumers being hit by something like tariffs. The extension of these tax cuts might be, according to my sources, more needed than ever. Is there a potential growth story here that could offset some of the economic risks of the deficit growing, at least in the near term?
Look, the 2017 tax cut the corporate rate from 35 to 21. There really was a growth element to it. In this case, though, most of the new tax cuts we're talking about here are things like tax-free tips, tax-free overtime, and tax-free Social Security. That has nothing to do with economic growth and everything to do with what were just giveaways during the campaign. So this is not a very well-designed, growth-oriented tax reform. And in fact, my friends who are, more on the center right, who have been wanting to see growth-oriented tax reform are disappointed by this as well.
Yeah, that's interesting. I want to zero in on that through the lens of the cuts to Medicaid, because this is something that you have noted is not necessarily a stable way to cut costs, given the impact that can have on people, increasing visits to the emergency room, for example. Can you talk me through the economic impact that cuts to Medicaid could have?
Yeah, look, we would love to cut fraud, waste, and abuse in Medicaid. We would love to have greater efficiency in the health system. But when the Congressional Budget Office took a look at this law, it basically said it's going to result in 10 million people losing their health insurance coverage. So the main thing is it pays less for health care. That will lead states to cut back on the health care they provide. And, you might say that we can't afford to give insurance to these 10 million people, but don't pretend, that's not my view, by the way, but don't pretend that it's all about fraud, waste, and abuse. These are people, most of whom are working, most of whom are citizens, and they're just getting caught up in new, paperwork burdens.
And Jason, I wonder if you can help our audience out here in terms of what the next big risk might be for markets in this environment. I know you're an economist, but given your expertise in Washington here, what do you think is that risk that folks need to be paying attention to? If it's not the deficit, because that was kind of a known problem in the room, is it the tax plan? Is it these tariff talks? Is it immigration policy? What's the next big policy risk?
I think tariffs are, because that is the place where you can have the most rapid change. We could have the reciprocal tariffs coming back. A lot of these trade talks appear to be going much less well than was hoped for example, with Japan. And our trade deficit is here to stay. And that has been the main motivation for the tariffs. So that is what I would continue to keep my eye on.
Jason, thank you so much. Always amazing to get your insights. Appreciate it.
Yeah.
Former President Joe Biden has been diagnosed with an aggressive form of prostate cancer that has spread to his bones, his office announced on Sunday. In a statement, his office noted the cancer was treatable, though the diagnosis represents a more aggressive form of the disease. The former president and his family are currently reviewing treatment options with his physicians. Prostate cancer is one of the most common cancers for U.S. men, according to the Centers for Disease Control and Prevention. In a Truth Social post, President Trump wrote he and the First Lady Melania Trump were saddened by Biden's diagnosis, wishing the former president a fast and successful recovery. We'll continue to follow this story and bring you updates. More to come on Yahoo Finance. It's now time for some of today's trending tickers. This morning we're watching Nvidia, Qualcomm, and Netflix. First up, Nvidia CEO Jensen Huang announcing the development of humanoid robots while at a tech expo today. The chipmaker also opening up its high-powered NVLink technology, which allows companies to build semi-custom AI servers within Nvidia's infrastructure. Next up, Qualcomm returning to the data center market. The company says it'll make custom data center central processing units, or CPUs, that use technology from Nvidia to connect to Nvidia's AI chips. And finally, Netflix downgraded to neutral from overweight at JP Morgan. Analysts citing reduced risk-reward appeal following the stock's recent rally. It's a valuation issue for them, but still, they increased their price target from $11.50 to $12.20. The stock is up more than 90% over the last year, hence that valuation call. And you can scan the QR code on your screen and track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Nvidia CEO Jensen Huang announcing big developments at a trade show in Taiwan today. The chipmaker launching a new system called NVLink Fusion that'll allow companies to build semi-custom AI servers with Nvidia's infrastructure. Huang also saying the company is building software to train and power humanoid robots in factories. Join me now on this, Daniel Newman. He is Futurum's CEO. Dan, great to speak with you this morning. Thanks for making time for us. Talk to me about these developments, obviously the big headlines coming out of this, but also what it signals for Nvidia going forward.
Yeah, good morning, Madison. Thanks for having me. Yesterday was a big, or today, depending where you are in the world, was a really big splash. Jensen Huang spent a good bit of time sort of reiterating where we're at and how quickly this AI is diffusing and the investments that NVIDIA have made and why these are so important to what comes next. But as you mentioned, two of the big announcements, one being NV Fusion, sort of opens up the walled garden. A lot of people have looked at NVIDIA and kind of called it the Apple of the AI ecosystem. Everything has to be all NVIDIA. And while this NV Fusion doesn't completely make it, say, open in the sense of making all of the different chip makers available to the different NVIDIA infrastructures, it does open up CPUs like the one you mentioned from Qualcomm just a moment ago to be able to pair with NVIDIA. And this is powerful in terms of bringing forward NVIDIA's ability to connect these computers together and start to drive innovation outside of the NVIDIA ecosystem, but also back in. As Jensen said, he wants you to buy something from him. On the other side, on the Groot 1.5N and what they're doing with Dream, it's so powerful. We know that the next big frontier of AI is all about being able to connect the physical world and make it, sentient and make it able to understand the world. And with what they're doing with Groot, it's really advancing, bringing it forward. And it's not just about NVIDIA, it's about all the companies building robotics and building humanoids, being able to move faster.
So, Dan, thank you for that overview. When you think about these developments from an investor's perspective, are they bullish or bearish for NVIDIA, given that they are sort of shifting away from that walled garden approach?
I think it's largely bullish. Of course, you could say you want everyone all in on NVIDIA. I'm here at Dell Technologies World, and I guarantee we're going to see more all in on NVIDIA. But realistically, that's just not how enterprises and how hyperscalers build. We know that the large hyperscalers are building some of their own custom compute, but they're also building with NVIDIA. Why not open that up so these companies can go big, but still benefit from where NVIDIA is leading? And that's in many areas, including how fast they can connect these machines to one another to deal with this massive volume of data. As we move to these agentic systems, which we are in the earliest days, and then of course, as we do connect the physical world, we're gonna need so much compute, so much energy, so much efficiency, and so many tokens that I think trying to close the garden off entirely is probably a risk. And Jensen right now is playing his cards really well, whether it's how he's dealing with the politics of China and the Middle East, or how he's handling kind of opening up just a little bit to make sure that NVIDIA investors have a way to grow, even if not everything is NVIDIA silicon.
Yeah, let's talk about the geopolitical dynamic happening with the company obviously announcing that office in Shanghai. To what extent do you think it is a risk for Nvidia to be caught up as sort of a non-tariff barrier that can be looped into all of these pending negotiations, primarily with China? Do you think that that is going to continue to be a volatile headline driver for this company?
It is going to be volatile. And this is really a two-sided argument. Jensen and Nvidia wants to see its AI diffuse to the world. What happened last week with Humane and across the Middle East was really bullish to see Western AI technology being selected by countries that we do have deep partnerships, but also countries that are complicated in politics, in economics. And seeing that, diffuse to the Middle East is a good example. China is going to be the most complicated. We saw it years back with the telco infrastructure. We're seeing it now with AI infrastructure. We've heard it from the Trump administration. The US and the West wants to be the world's supplier of AI innovation. We want to make the chips in the US and not just in Taiwan and not just in the East, but we also want to make sure that it is the US and the West's version of AI that gets diffused, that gets deployed. And that's why those laws changing were so important. So we are really in a battle. China is the only other economy in the world that has the capacity and the intent to do what we are trying to do with AI. And the next multiple decades of economic leadership, Madison, are going to be driven by who wins this AI race. China's going to compete. I would never say they're not going to get there. I think they have every shot of getting there. We're making it difficult. But I believe Nvidia, I believe the West is showing, and I think Jensen's hedging very well in the event that a trade deal, that we're able to find balance in policy and to be able to continue to supply China with something to maybe slow its own innovation, or at the very least continue a partnership on an economic level.
Dan, I hope you can put a bow on this for me, because I've done a lot of reporting on Amazon and their approach to AWS's approach to Bedrock and sort of their focus on having a slew of options for their customers. And when I read these announcements coming out of Nvidia, it sounds Amazonian to me, this focus on multiple models that would be accessible to customers. Walk me through that. Am I reading that correctly? And is that a positive for this AI chip leader to sort of open up more choice for their customers?
I think we're going to continue to see rapid model diffusion. I think we're going to see a number of different players. Of course, NVIDIA's been doing this for a long time. It's had a vision about building out software. It's been building out models to be used for development for a long time. And of course, you've got Bedrock, as you mentioned, and Microsoft is trying to do the same. Google is trying to do the same. Every one of these companies is trying to build a platform that allows choice. We know that very little enterprise data, for instance, has even touched AI yet, but there's a ton of complexity in terms of exposing all that data, making it available to compute, and building abstraction layers that developers and soon AI developers can access more quickly and generate outcomes. So NVIDIA, of course, wants to lead the way. It wants to show what it's capable of doing, especially things like industry focused, like for robotics or like for lithography, LLMs. Amazon, I think, is really trying to expose and make this available to enterprises. And I think there is a need for both. NVIDIA is leading much of the way in terms of overall development of AI. And then these cloud hyperscalers are making it accessible and usable for enterprises to start getting that outcome, which, by the way, is what investors are waiting for, is turning all this AI into something that can be measured through consumption, utilization, productivity, and greater efficiencies.
Dan, always great to get your insights. Thanks for joining us this morning. Appreciate it.
Thank you.
We're going to have all your markets action ahead, so stick around. You're watching Morning Brief. That is your opening bell on Wall Street. Taking a look at live images from the New York Stock Exchange and the NASDAQ in Manhattan. Let's get you a check on the markets here. Taking a look at how the major averages are doing following that downgrade from Moody. Stocks are under pressure in part because of the move to the upside that we've seen in Treasury yields. You've got your 10-year yield up above that 4.5% level, your 30-year above 5%. The first time since 2023 that we've seen this key psychological level. Before that, it was 2006. 107. So certainly a key level to watch when it comes to any potential downward momentum we might see going forward here. You've got the major averages also under pressure. Your S&P down about 1%. Your tech-heavy NASDAQ taking it on the chin as well, down a little over 1.25%. The Mag 7 names leading the downside pressure there when it comes to the NASDAQ stocks, snapping 5 straight sessions of gains. Let's get it over to Yahoo Finance's Jared Blickery for a broader look at what's moving. Hey, Jared.
Thank you, Maddie. I was kind of keying on those that 5-day streak coming to an end today, too, in the stock indices. But I really got to fast forward to the bond market. That's the NASDAQ on your screen right now. But let me just show you what the 30-year is doing. Usually I talk about the 10-year, but the 30-year above 5%. And this is a 5-day chart. You can see just opening above that level. And as you said, Maddie, we haven't been here since 2023. This is a 3-year chart. And let me put some lines on it so you can see a little bit better. We poked above ever so briefly in late 2023, and then we came back down, and we have come close or touched that level multiple times. But you notice the trend is we are pulling back less. And so the big concern with the Moody's downgrade is that this means something bigger for yields. And as I was talking about last week on Catalyst, 5% is a huge level, and it has caused problems for stocks in the past. And I just want to address what happened with the VIX in 2011. That was when S&P downgraded U.S. debt. And here's a 20-year chart. I got to put some candlesticks back on here, but you can see we were already elevated at the time. We were north of 30 in the VIX, and then it shot all the way up to 40, 50. It took until 2012, the beginning of 2012, so basically 4 months to return to normal. Now, this time is different. Back in 2011, we were all worried about sovereign debt. The global financial crisis was fresh in everybody's minds. So it was a different time. And right now, the VIX is still only 19.54, so not even above 20. And 20 is kind of a big psychological level for the VIX. And I'll put some lines back on there. Bottom line, we want to monitor this situation closely because the bond market is really more important to risk markets than even stocks are in the signals they get right now. And there are lots of implications for this. So let's go over the sector action. As I was explaining last week, tech tends to take it on the chin the most when we have the 5%, when we have the 30-year above 5%, and especially when it's due to the real yields surging higher. That means financial conditions are tightening. Here we see tech as well as consumer discretionary and energy. And you can also throw consumer communication services in there. Those are the mega cap sectors. Those are leading to the downside today. Inside the NASDAQ 100, a predictably kind of ugly picture. Microsoft in the upper left, that is a standout. But for the most part, we're seeing Tesla down 4.5%. That is leading the Mag 7 stocks down. And one of the other things that's been going on, I mentioned the real yield. You can break the Treasury yield into 2 components, real yield and break-evens. Break-evens are inflation expectations. Those have been surging too. And we saw that in the last consumer sentiment report. Under those conditions, commodities tend to do well. And I think it's no surprise that we're seeing gold having its biggest jump in about 2 weeks here. And we had seen it kind of putting in a topping formation before, and I was calling this out, looked like an M-top, but it has surged back above that level. So it might be a false breakdown. If we see real yields hold above, if we see the 30-year hold above 5%, I would expect to see gold continue to climb, especially if we see inflation concerns mounting. I want to close on Bitcoin because interestingly over the weekend we had a run at all-time highs, and that all-time high is around 107, 108,000, but we have pulled back from that. This is a 1-year chart, and you can see here we just pushed right against those. We are back down to 102,000, so a lot more volatility in Bitcoin that we're seeing. And also interestingly, we're seeing things jump around a little bit, but for the most part, we're seeing a lot of negativity and downside risk in the crypto space. So all in all, risk off with 30-year above 5%, and that's what we need to monitor.
Certainly is. Jared, thank you so much for that breakdown. Appreciate it. It's time now for today's strategy session. Stocks and bonds selling off in tandem amid the Moody's credit rating downgrade of the United States. But is this a buy the dip opportunity for both stocks and bonds? Joining us now with more, Jeff Crumpleman, Mariner Wealth Advisors Chief Investment Strategist, also Kathy Jones, Charles Schwab Chief Fixed Income Strategist. Thank you both for being here. Jeff, I want to start with you. This morning, what do you think is the bigger headwind for stocks? The downgrade from Moody's or just the lift that we're seeing in yields?
Well, I think this is kind of news du jour, and our message has been to be balanced And I think you have kind of a mixed picture out there. And so, yeah, for the longer term, if we don't try and prophesize where yields are going to go, we watch where the trend is, and you can hit certain levels where all of a sudden that becomes a concern for the equity markets. But when I look at the downgrade, the other two rating agencies have downgraded a long time ago. I don't think this is like huge news. And in terms of yields, when we look at leadership in the equity markets, yeah, today the cyclicals are down, but it's really been a reassertion of kind of cyclical leadership. You've seen consumer discretionary, industrials, and the more cyclical areas of the market lead here in this rally. And I think if it's a true headwind, you wouldn't be seeing that. So, I think that after kind of a hard rally and run, you get news like today, a downgrade, yields creeping up a little bit. That's certainly not insurmountable as to be expected where you get a little softness in the market today.
Yeah, sounds like you're saying it's a little bit more just exhaustion in that rally. But Kathy, I want to bring you into the conversation because that 30-year at 5%, are you a buyer at those levels?
No, we've been suggesting staying at benchmark intermediate term duration or a little bit lower because our concern is you have a mix of policy here that it doesn't really hold together very well. It's kind of incoherent. So on the one hand, you have a very fiscally expansive budget, which coming at a time when we already have a large and growing deficit. So that doesn't help on the long end. And then you also have a policy of trying to deglobalize or reduce our trade deficit, which means the dollar pretty much goes down and capital inflows from foreign investors go down. So on the one hand, you're feeding the need for more capital inflows at the same time your policy is discouraging those capital inflows. And so what you see is this tension in the market, and I think it expresses itself in the weaker dollar and higher long-term yields. So we prefer to stay intermediate term or below and stay up in credit quality until all this gets sorted out in one fashion or another.
Yeah, and Jeff, come back into the conversation because Kathy is mentioning sort of the uncertainty in the room that remains with the policy lack of clarity right now. I wonder then, how do you advise clients in terms of positioning? Do you do the Mike Wilson model this morning saying buy the dip? Do you follow the Lori Calvasina model from this morning that there's concern about EPS going forward at these current levels? Which is it?
We're hold your ground. And our theme going into this year was clear air turbulence, where that happens at high altitude, where you get air pockets out of nowhere in blue skies and you fall, and then recover as you get fairly good pilot navigation and you find out that the data is still supportive. So in this environment, it's all about removing portfolio imbalances. Make sure you don't have too much Mag 7, but make sure you have some. Make sure you have international as well as domestic exposure for those reticent to have any international. Make sure that you have some. And then across your sectors, you need defense and you need offense. And so the whole idea is to be balanced, but hold your ground. And I think it's cavalier and premature to say buy in the dips. It's also premature, I think, to say you need to run for the hills. And it depends on what type of investor you are. If you're an aggressive investor, okay, fine. You can buy in the dips. If you found that a 20% correction or close to it freaked you out, maybe this is a time where we've recovered, where your overall allocation equities was too high to begin with. If you can't withstand that from a psychiatric standpoint, maybe you reduce your exposure. So that's where we are.
So Jeff, I heard you mentioning tech there. Do you sell or fade into rallies on tech?
So we're neutrally weighted in tech, but more diversified than you would see in the S&P 500. The exposure to Mag 7 makes us nervous, the amount. So selectively, we find some very attractive names in tech. Quite frankly, I think the industrials, when we have this need to build out the grid, the power demand that's going to come, there are some exciting opportunities in industrials, and that's where we're overweight at this point in time.
And Kathy, I want to turn to you on foreign demand for U.S. Treasuries. This is something that, of course, is of keen concern given the amount of foreign holders of U.S. debt. Torsten's Lock out with a chart this morning indicating that we have seen a little bit of pressure to the downside in terms of foreign buyers of U.S. Treasuries. How much do you weigh that as a potential headwind or a concern for investors in the bond market going forward?
Yeah, I would say this is maybe an imperfect measure of foreign investment demand. This is just in 30-year auctions, which, measuring auction demand it doesn't capture the whole story about foreign investors. So we've had particularly foreign households be particularly interested in U.S. assets, including treasuries. So I'm not too concerned about that in the sense that there's still demand for U.S. Treasuries, and there's no real replacement in the global economy for U.S. Treasuries. My concern, though, is that we're on the margin, we're pushing them away. By trying to reduce our trade deficit in goods and services, we are, by definition, getting less in the way of capital inflow. We're reducing our capital account. And so by doing that at a time when we desperately need to finance this bill that's coming through and a lot of activities, that doesn't cohere. So I'm not worried that they're going to run or stampede out of treasuries, but I think on the margin, what you'll see is demanding higher yields to bring that money in, because now what we're doing is we're cutting off the kind of automatic inflow, and then we have to go out and solicit that inflow, and we have to do it with higher yields.
Yeah, really well said. Thank you so much, both to Jeff Krumpelman of Mariner Wealth Advisors and to Kathy Jones of Charles Schwab. Appreciate you both. It's time now for our chart of the day. I'm taking a look at the credit rating scale amid that key downgrade of the U.S. by Moody's here. So you've got three major credit agencies, and just like you at home might have a credit score, well, the United States also has a sort of credit score through its credit rating scale that each of the three agencies give it. Now, previously, we already had S&P and Fitch downgrading the U.S. to their second best descriptor here, which is when you have very high credit quality, very low credit risk. Previously, they had the U.S. at the highest credit quality level with minimum credit risk. Essentially what that means is the U.S. was the best possible investment according to those credit agencies previously. And now Moody's was the final holdout, keeping the U.S. at that highest credit quality minimum credit risk level. They recently downgraded the U.S. On Friday here. Now the key question is, what are the differences here, and what does it mean for you and your investments? Well, previously, when we saw these downgrades from S&P and Fitch, there were sort of different reasons, right? The one that was coming in around 2011, I believe, was related to the U.S. soaring through its debt limit. And then you had Fitch coming out with their downgrade in 2023, which was also just a concern about the ballooning deficit. My sources this morning in notes to me saying that the Moody's downgrade is very similar to the Fitch downgrade. It's just about concerns to the deficit. Moody's noting in particular that Trump's tax plans could increase the debt to GDP ratio to 9% by 2035, that it could cost up to $4 trillion. And they're worried about that ballooning deficit problem, hence that downgrade. Now, what's important for you to know as an investor here is that historically, we don't really see these downgrades leading to a lot of pressure in the stock market. What we do potentially see is them leading to pressure in the bond market. We're seeing a little bit of a sell-off today. That leads to a rise in yields. Then that makes bonds start to look a little bit more attractive. So maybe that takes a little bit of wind out of the sails of the stock market as investors look to the bond market. That, of course, is going to be the key question going forward. Do investors continue to find safety in the U.S. bond market amid a little bit of that sell the U.S. exceptionalism, fade the U.S. exceptionalism rally because of this downgrade here? We're going to have all of your markets action ahead, so stick around for more. You're watching Morning Brief.
When you look at the magnitude of some of the cost increases on certain categories of items that are imported, it's more than what retailers can bear, it's more than what suppliers can bear, and so we'll work hard to try to keep prices low, but it's unavoidable that you're going to see some prices go up on certain items.
That was Walmart CFO John David Rady telling us on this program tariffs will make price increases unavoidable. Meantime, President Trump says Walmart should eat the tariffs and not raise prices for consumers. Joining me now on this, Stacey Woodlitz, SW Retail Advisors President. Stacey, great to have you this morning. Thank you for joining us. I think the key question ahead of earnings from the likes of Home Depot and Target later this week is what does Walmart signaling an increase in prices mean for those other retailers? Does it give them a free pass this week?
Well, I think we know that prices are going up across the board, and that is tough for companies. And for Walmart, of course, they are the biggest and they have the most power to push back on vendors and share that cost, to not pass it all of it on to the consumer. That's what we saw back years ago when we had tariff increases, and I think that's what we'll see again. So they offer the best value in the market. But I think, you've heard from companies across the board that we will see prices go up, absolutely. And the consumer is still being very choiceful, and that will eat into discretionary, no doubt.
And we're also hearing from the president. He talked about over the weekend on X the idea that Walmart should just eat into their own profit margins to stop these price increases from hitting consumers. Walk us through that. And this is something that obviously as investors we know really well. You never want a company to eat into their profit margins, but just talk to me about that potential move forward for Walmart. If they did cut into their own profit margins to cover the cost of tariffs, what would that mean for them?
Well, I don't think that's going to happen. It's a nice idea, but Walmart is not going to take a hit on its operating margin that it's worked so hard to get where it is. And also, by the way, their e-commerce is now profitable. So I think that's unlikely. I think what is more likely, again, is that they're going to be able to press vendors increasingly to say, do better, do better. And the vendors are actually the ones who are going to be more under pressure than Walmart. And yes, of course, they'll pass a little forward. Other retailers don't have that same kind of power to push back. So I think Walmart's going to be one of your top performers this year.
Yeah, so let's go on the opposite end of that. Who is most at risk because they don't necessarily have that negotiating power with their vendors that you just mentioned?
I would say you continue to look at the department store space. You look at specialty. You look at someone like Kohl's that's been in perpetual turnaround, that is just not really getting anywhere. That it's likely that some of their vendors will start to say, "Hey, is this where we want to be? Can they really push price increases through to the customer? Do they really want to shop here?" So I think that'll continue to be under pressure. On the flip side, on the more positive side, we're going to hear from TJX this week. Home goods continues to be on fire. If you're not building a home or buying a new home, you're upgrading your home. And that's what TJX in home goods offers. We'll hear from other retailers like Urban Outfitters. Anthropologie margins are still really strong. Little to no discounts there, and customers are still responding to merchandise. So there's definitely stories out there. Deckers, of course, with Hoka, that stock came way down. The DTC numbers there look intact, margins look intact. And of course, Ralph Lauren has been just selling full price, hasn't discounted, and is still sticking to that. So there are plenty of opportunities out there.
And Stacey, I want to end on Target. How are you thinking about their earnings this week? What do you think the story is going to be?
Well, Target they've struggled to find the right balance. And last quarter, they returned back to promoting, and I think we'll see a little bit more of that. This quarter, I think, discretionary got a little bit better, but it's still weak. They're still not doing anything like Walmart's doing. They're not seeing the same traffic increases. But if you look at the opportunity for them, if Kohl's continues to struggle, that is one of their biggest competitors. What Target has going for them is the traffic driving food options. So if they can continue, they have an opportunity to continue to take share from Kohl's. And if they can execute, the stock is worth a look. But so far, they haven't been able to gain the kind of share from Kohl's that they should be.
Really great point, Stacey. Thank you so much for making time for us. Appreciate it.
Good to see you.
You too. We're going to have all of your markets action ahead, so stick around for more. You're watching Morning Brief. JP Morgan Chase's 2025 Investor Day is underway. Some of the things we are watching: commentary on tariffs, the company's financial outlook, tech spending, and succession planning. First up, how the bank is assessing the early impact of tariffs. JP Morgan saying tariffs could hurt some parts of the business, like wholesale, commercial, and industrial loans, depending on which industries are hit and how much of the costs could be passed on to the consumer. The firm's consumer and community banking head said consumer sentiment is worsening, but it's not yet translating into changes in spending. Very interesting economic outlook there. We're also watching the firm's outlook for 2025. The bank saying no big changes, maintaining its full-year net interest income forecast of $94.5 billion, essentially in line with estimates. The bank will revisit its guidance in its second quarter earnings report that comes a couple months from now. JPM says it's positioned to deliver strong returns across a range of macroeconomic conditions and that reserves reflect the current level of uncertainty. Excess capital hitting around $57 billion in the first quarter, making the firm, quote, positioned to protect and grow the franchise under a range of circumstances. Another thing to watch, tech spend for the year will be about $18 billion. The firm says it's helping increase efficiencies, particularly from none other than AI. The firm will also resist headcount growth and leverage efficiency of its current staff as well. We're also, of course, watching for an update on Jamie Dimon's potential retirement. Last year, Dimon said he had less than 5 years left, and investors are eager to learn more about his succession planning. Of course, we will bring you any of those headlines as we get them. That's going to do it for the morning brief. Join me in the next hour for more analysis on Catalyst Ground.